Welcome back, traders, to another exciting video. In this video I'll be sharing with you guys the 3 top entry techniques or strategy in entering the markets and getting the best out of the market. So let's dive right into it. The first one is the instant execution. And the instant execution allows traders to enter a trade at the current market price. When you place a market order, the broker executes the trade immediately at the best available price. So you have absolute control over your trades and price or where you enter. And some of the advantages of it is immediate trade entry, useful for entering or exiting trade quickly, especially during high momentum news or events. So that's one of the advantages of it, and you can enter or exit the market exactly when you want without waiting for price to get to a level. So you can actually enter a buy, sell, or even close your trades whenever you want. But one of the disadvantages of it is you need to be on your charts to constantly monitor where price is. So that's one of the disadvantages. And as you know, always be on your charts triggers impulse trading, and you will start taking trades you shouldn't be taking, or you will not be patient enough. FOMO will kick in, fear of missing out, and you just keep taking buys or sell. So that's one of the disadvantages of an instant execution, and especially during news or high volume or volatility period. There's high risks of slippages, and slippages is when you take a buy or a sell, but your order doesn't get filled at that price you want, but get filled at the next available price. So there's a difference there. So that's some of the disadvantage of an instant execution. So the second one on the list is the stop order, and the stop order are pending orders which we set above where price is. And the reason for that is we can only get trigger into the trades when price start pushing in our direction, when there's enough volume or momentum, and that's the only time we get trigger into the trade. We enter with volume and price moves strongly in our direction. But as long as price is trading above that level, we are still out of the market, we are still in a safe position. But we can only get trigger in when price start pushing down in our direction. There are pending orders, and we have the buy stop and the sell stop order. And one of the advantages of this is it's good for breakout trader. If you trade the breakout strategy, you need to be using the buy stop and the sell stop, because this is the best entry technique for that strategy. And I'll be sharing with you guys some example using. So here is example number 1. We are going to be using the sell stop order. So we are currently on pound JPY, and this is where we identify price. Price is currently at the key level. We anticipate price to continue down, but we are not going to be using the instant execution. We are going to be using the pending order. So I'm going to be placing my sell stop order below this candle. So the only time I'll get trigger into that trade is when price start pushing strongly down in my direction, because I anticipate price to keep going down. So I will place it slightly up below the candle. So I'm going to do something like this. This red line is my sell stop order. We are just using this as an example. So I can only get trigger in when price continue pushing down strongly. And even though I'm not on my charts, I can close my chart as long as I've set my sell stop order. My stop loss can walk away and leave the market to do what it wants. That's the freedom that comes from using this stop order, the pending order. And it reduces your emotional attachment to your trades. You don't need to be constantly on your charts to monitor your charts. You can just set it and walk away. So that's the sell stop example. So the last one on the list is the limit order, which is the sell limits or the buy limits. And these are orders placed at level we anticipate price to reverse at. So we set our limit orders at levels we anticipate price to reverse at. This is best for reversal traders who take trades at key levels. Let me share with you some example. So as I said, it's best for reversal traders who take trades at key level, at support level or resistance. So you can set your buy limit order around some of this level. So if price come and tap that level, you get triggered into a buy, and if price reverse, you are laughing all the way to the bank. And the same thing applies with the sell limit. You can set the sell limit around some of these weak areas. If price get to that level, it will trigger a sell, and if price continue down, you are laughing all the way to the bank. So that's how the limit order works. You set a price where you anticipate price to reverse at. So that's how you use the limit orders. The limit order is basically used by reversal traders. So some of the advantages of that, it allows you to set your trades and wait for it to play out. It reduces the emotional attachment and impulsiveness in taking a trade in the market. And another advantage of it is good for reversal trading, as we said. And you can set and forget your trades. You can close your chart as long as you have set your stop loss, and just set it and wait for it. You don't need to micromanage your trade every second or every minute. You can just set it and walk away. If you end up winning, that's great. If you lose, that's trading for you. So most of this, like the stop order and the limit orders, it helps you to plan your trade, to wait for it to play out. So that's some of the advantages of it. But some of the disadvantage of the limit order is you might not get trigger in, even though price come back to the level. Maybe price won't push deep into where you place that limit order, and you won't get trigger in, and price will still go in your direction. So you don't get trigger into the trades and price move in your direction. And that's one of the disadvantage of a limit order. Price mostly don't trigger you in if you don't set it well. Example is mostly price break that support or resistance area, and if you set sell limit around, like if you set the sell limit here and price continue up, you lose that trade. So basically the foundation of a limit order is anticipating a reversal. So that's just it. If you're a reversal trader, you should try to start using the sell limit order. It's best for your strategy. That's a 3 entry technique you need in forex trading to be profitable, but you don't need to use all. But you should understand that the market is dynamic, and you should try using like two of those techniques. You don't need to use 3 of them. Try to backtest at least 2 of them and see what approach or strategy or entry technique works best. Then focus on that, because forex market, nothing is certain. The market is dynamic, it's always changing, so you need to know how to enter the market and when to enter the market, and which entry technique is best for each occasion. That's how you dominate the market. So hope you gained value from the video. If you did, give us a thumbs up. If you have any question, drop it in the comment section below and I'll reply to you. So thank you and see you next time.